following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp, brought to you by Sogo Trade, an extraordinary value in online trading. Why pay more for the same trade when Sogo Trade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo, Dan Passarelli, and John Critchley.
All right, everybody, those marching boots and that rocking tune mean that it is time once again for Options Bootcamp, the program where we take you, the raw options recruit, perhaps the stock trader who's thinking about dipping his toe in the options waters, and we break you down and rebuild you into seasoned options veterans. My name is Mark Longo from the OptionsInsider.com as well as from the Options Insider Radio Network. And I am joined yet again by my boon companions on the old program, one old, one new. So perhaps we'll start off in the new corner this week. You may have heard him on our most recent episode. He is joining us yet again because my black-hatted co-drill instructor is still on assignment perusing the jungles and hinterlands of Zimbabwe. So Randall Liss has once again stepped up to the plate and donned his black cap to join us on the old drill instructor squad. Randall, welcome back to the program.
Thank you, Mark. It's good to be here.
And once again, remind the listeners here at the top of the show, if they want to learn more about what you have going on, what is the URL they should go to?
Well, my website is www.thelissreport.com. I was a market maker for many, many years on the floor of the European Options Exchange in Amsterdam, and now I'm an options educator who seeks to simplify and demystify the world of options trading.
And you certainly crank out a good deal of content over there on the List Reports. You're a one-man show, but you certainly fill it up with content. So if you have any questions, you're curious, you want to learn more, surf on over to thelistreport.com and read all of Randall's latest educational articles. And, of course, as always, joining me on the program today as well, he is the options major domo over there at sogotrade.com. He is none other than Mr. John Critchley. John, welcome back to the program, sir.
Hi, Mark. Hi, Randall. Good to be back. Great topic today. One I'm excited about, and I'm really glad that we have Randall so we can hear his view on this topic.
Yeah, I'm pretty excited about today's topic as well because we've touched on it on a previous show, but I think it's really a good time to dive into it and take a much longer and deeper look at this strategy. So without further ado, let's keep on rolling right on into our basic training segment.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, sir. Pull in, prepare to learn. Yes, sir.
All right, everybody, welcome to our basic training segment. If you're just joining us for the first time, this is, of course, a portion of the show where we break down a basic options concept for you and teach you how you can implement that concept into your own trading and into your own portfolio. And today, we were kicking around before the show what we should really talk about today, and we all kept coming back to one topic, something that we visited earlier in the show, but I think given what's going on in the marketplace right now and just the overall utility of this tool, of this technique, it's worth really taking a deeper dive into it. We're going to talk today about using options as a stock repair tool, a stock repair strategy. And you may remember, if you've been with us for a while, we touched on this back on episode 20 when we talked about options and using options in lieu of or in conjunction with stock. So if you want a bit of a primer, a first take at the stock repair strategy, I encourage you surf on over to theoptionsinsider.com or on wherever you get your podcast, iTunes, Stitcher, Aha Mobile, wherever you get our show, and go back, search for episode 20, and you'll hear our first take on the stock repair strategy. But of course, a lot of you have joined us since then. We have a lot of new listeners, a lot of you who come in and may have missed some of the archive shows. So we thought it was worthwhile revisiting it and taking a little bit deeper dive. Let's start off with kind of the basics of what this strategy is, what the stock repair is. As the name implies, it's useful in a scenario where you have an equity position in your account that's taking a bit of a downturn, taking a bit of a hit. And you're looking at it now and saying, well, gee, what do I do with this stock? It's down 10%, 20%, 30%, perhaps more. What do I do with it? Is it now a quote-unquote long-term investment? I know all of us have thrown that one around from time to time. A short-term trade suddenly morphs into a long-term investment because you want to hold it until it breaks even. But there are some other options, pun intended, when you want looking at that in that scenario, and the stock repair strategy is a great one. So let's walk through what we're talking about here. Let's say you have this proverbial stock. It's taken a drawdown, let's say 20%. Now, you're confronted with a couple of different options in that scenario. The first one is really just to, if you think the stock's going to retrace, then to say, you know what, I'm going to hold this. This is now a long-term investment. I'm going to wait for this stock to rally and make my money back. That's option A, let's call it. Option B is to say, well, I liked it at $10. I love this stock at $6 or $5. So I'm going to double down. I'm going to buy more of this stock at this lower price and lower my cost basis on the stock and therefore lower my break even. Of course, the upside to that is that you have a lower break even. The downside is that you have to invest sometimes substantially more money in order to do that. So let's call that option B. And option C is what we're talking about here today, the stock repair scenario. And this is a relatively simple strategy. It involves, you have this stock position that you own, and now you're looking at the underlying and saying, I think it's going to retrace in the near term, not perhaps shoot up dramatically past where it was, but probably make some or most, if not all, of that back that I lost recently. So you can use options to make that money back faster and perhaps a little bit more easily. And the way we do that is really by attaching a simple vertical ratio call spread to that underlying position, which essentially means, let's say the stock has dropped from, let's use my typical XYZ example. Stock drops from 50 down to 40. You're long 100 shares, so now you're out $1,000. Total. You can of course hold the stock and wait for it to rally back. You can buy more of the stock, or you can do what we're talking about here, which is you buy one of the at the money calls, which in this case is the $40 call, and then you can sell two of farther out of the money calls, and that's up to you where you choose to sell those calls. In this scenario, you can sell two of the 45 calls, and they'll be because you're selling on a ratio. You can usually do it for a reduced price, if not even money. Let's say in this scenario, you can do that for even money. Buy one to sell two. Now you have a vertical call spread in addition to this long underlying position. Your net additional outlay for that trade is zero. Now let's say the stock rallies back halfway, rallies back to 45. You've now made $500 on the underlying stock position and another $500 on that spread. So you've essentially broken even. The stock only had to go back halfway to where it was for that trade to pay off, and you're now back to square one. You've broken even using a zero-cost options trade. So that's a pretty basic example, but that's kind of gets to the heart of what we're talking about here today. Now, Randall, I know you're a big fan of stock repair strategy. So first off, why don't you give our listeners your thoughts on this strategy, when they should use it, when they shouldn't use it, and perhaps you have a few examples of your own you'd like to share with our listeners.
Thank you, Mark. I'd be happy to. First of all, let me begin by saying I do not believe in doubling down. I do not believe in adding to a losing position. In Europe, we used to call that the Monte Carlo fallacy. If the roulette wheel comes up black every single time and you keep doubling your money, waiting for the red to come up, you're going to go broke. Do not reinforce a losing position by adding to it, in my view. Next, Mark mentioned, is it a long-term investment? Well, if it actually is, if you believe in the stock, then there's no reason to panic and not necessarily any reason to do anything. For instance, let's say you own a stock with a dividend yield that you're comfortable with. There's no real reason to do anything. The next point I would like to make is that no stock repair strategy will work if the stock is going to zero. So I like the 1x2 call. It's my standard stock repair strategy. I would like to suggest another one. Sell your stock, take a loss, and sell a just in the money put for hopefully a fat premium. That way, if the stock rallies back, you collect that put premium to offset some of your loss. And if the stock continues to fall, you buy back into the stock, but at a lower level. That's a put stock repair strategy.
Yeah, that's something I wanted to get to, too. I think we'll get to more flavors of it as we get a little bit deeper into the conversation here. But, the stock repair strategy is not a monolithic, one-size-fits-all type approach. It really varies on what you're comfortable with and what you prefer to do. Randall has outlined another perfectly viable alternative in the stock repair realm. Really, the stock repair usually involves some way of getting additional income into your portfolio and using that to perhaps offset a bullish position in the stock, an additional bullish position. But there are a lot of ways you can go about it. That 1x2 call spread is kind of just the standard that a lot of people like to go to when they first start talking about stock repair. Now, John, obviously, you're dealing with clients over there on a regular basis at Sogo Trade. They're calling up, asking about this, asking about that, asking about margin, I'm sure quite a bit these days, but also probably asking about different ways they can repair these types of positions. What do you typically walk them through when they come to you with an equity position that is down X%? Are you a fan of the 1x2 ratio? What's your approach to a stock repair strategy?
Yes, I'm a big fan of this strategy, and I think Randall stole a lot of my thunder. But the one thing I did want to mention that there is a downside to this strategy, and that's the downside is that what can happen is that, let's say the stock's 100, stock goes to 90. This is similar to Mark's example, just using different numbers, and you buy 190 call and you sell 295s, and then the stock rallies to 95. Great, you lower your break even to 95. But what happens if the stock then rallies, or stock rallies to 110? What happens? The best you can do in a particular case is to break even or lower your cost basis. So that's one of the downsides that I have to tell my customers about, because you have to make them aware that at some, the stock does rally hard back. You're giving up some of the upside, or you're giving up the upside. You're just lowering your cost basis. So that's the one thing that I like to mention to all my customers. But yeah, I'm a big fan of the strategy, and I think Randall touched on something that we're going to go later in the show about alternatives. That was a good alternative also. Maybe selling some puts, sell the stock, and then maybe sell some puts.
I like to, whenever possible here on the program, pepper our talk with some real-world timely examples. And there's a very timely one that I know a lot of people have been trading of late, and they've encountered this exact scenario, so it's a perfect example for us. It's a little bit cheaper than some people might usually like to use a stock repair strategy on, but nonetheless, it's a good example. I'm talking here about Dendrion. This was a $5 stock about a little over a month ago. They went into earnings. I know a lot of people were writing the $5 puts because they were collecting a relatively hefty premium at the time, maybe even 5.5 puts. And of course, the stock since has taken a bath post-earnings. It's trading right now $2.99, so at exactly 3 cents. So you have a scenario here. We are out pretty much exactly $2 since the last earnings. So a lot of people, if they were long, let's say 1,000 shares, now they're out $2,000 on this position if they were writing some of those puts. Maybe a little bit less if they collected some decent premium for those puts, but still somewhere around the $2 range. So this is a perfect example. What can you do with stock repair in this scenario? Well, first off, we have the standard choice of, well, you loved it at 5, you really got to love it at 3. A lot of people like to double down. Randall's not a fan of it. I am not really a fan of it either. Throwing good money after bad, not always the best scenario. But let's say you are still a bull here at Dendrion, so you can buy 1,000 more shares for $3. That brings your total outlay on the trade. Remember, you bought $1,000 initially at $5. Now another $1,000, additional $3,000 you're spending on that stock. So your total net outlay is $8,000. You've lowered now your effective cost basis to $4. That's one way that you could do this. And then if the stock rallies back to $4, you've broken even and made your money. But of course, you have a lot of money on the line now, $8,000. An additional $3,000 you spent on this one trade. That's an expensive proposition. And also, if the stock continues to drop, if it trends down to $2, let's say, now you're out an additional $2,000. So you invested $3,000. You're out $2 of that now right away. It's a bit of a dangerous ball game. And if you stay at $3, you spend that money and you've lost the opportunity cost, but you haven't really gained anything. Now let's say we start looking at options and we look at some of these repair strategies we're talking about. Bunch of different ways you could set these up. Pulling some real world numbers so you can kind of see how it impacts in the real world. Let's say you own the stock now at 3, you're long from 5,000 shares, same scenario, and you're looking at the options. You say, you know what, I'm going to put on a stock repair strategy. I like that 1x2 call spread, so I'm going to look at the October 3-4 call spread. That's 1 month out. The October 3 calls are trading right around 20 cents right now, and the October 4 calls are trading right around a nickel. So you have an ideal scenario where you can do a 1x2, not for even, but for relatively close, for a dime. So this spread that should have cost you 20 cents is now, actually should have cost you about 15 cents, is costing you a dime if you do it 1x2. So you're taking it off a little bit less premium there. And the net outlay, you're buying it 10x20, so it's going to cost you net of $100 plus commissions and everything like that. So now you have a $100 outlay versus $3,000. Substantially better from an outlay proposition. Stock rallies back to 4. Of course, you make $1,000 on the stock, and you make $1,000 on that call spread. So you're back to break even at 4. Your net outlay, the net additional outlay, I should say, was only $100 versus the $3,000. Of course, if the stock continues to drop down to 2, you're still going to be out on the stock. Nothing's going to stop that. But the additional money you spent, you're not out another $1,000 on the shares. You're out only $100. So that's definitely a preferable downside scenario. And if stock stays at 3, of course, which is definitely a potential scenario, you're out the $100 you spent on that call spread. But the nice thing about this is because you're only spending $100 versus $3,000, you can afford to do this if you want to keep doing this 30 times before you essentially have spent the same amount of money. So that gives you close to 3 years for Dendrion to rally to have the same outlay as you're spending on that stock. And then the other option, some people may be a little bit more impatient. They don't think maybe Dendrion's going to get all that back, but maybe some of it, and they want to add a little bit of juice to the mill, a little grist to the mill. Then they can instead do the October 3.5 call spread. The October 3 calls trading about 20 cents, 3.5 calls trading about a dime. So now you have a net even outlay, no outlay at all. It's an even money trade. Stock rallies to 3.5. Now you're making $500 on the stock, $500 on the call spread with no additional outlay. You've made back essentially half your money. So if you think the stock is going to rally to that point, that may be a preferable scenario that you could do that. And then, of course, you'll be called away, and you're always free to do what we talked about earlier, which is a wheel trade and leg back into it again and generate more premium. But if you think that's the best you can do, that might be a better scenario. And again, the zero net outlay could be attractive to some people as well. Again, if the underlying drops in that scenario, you've paid nothing for that additional position, so you're not losing anything additional on that spread. So that just gives you a few ideas of what you can do with this stock repair in a real-world example that's going on right now. And a lot of people are wrestling with those Dendrion positions right now. So that gives you some ideas of what you can do. Randall may have a different take with writing the puts. John may have a different take. It really depends on who you're talking to and what their approach is. But stock repair is a very, very interesting and very multifaceted type tool that can be used in a variety of scenarios. Now, John, I know you probably have maybe a different take here on what I'm talking about on Dendrion, or maybe even just stock repair in general. So what would you like to add to this example here?
Now, the one thing I wanted to add that this is a great example of what we've talked about in the past about reverse skew, and Dendrion's a perfect example. And a stock repair strategy in Dendrion works so well for the reasons Mark mentioned, but also if you look at the option chain, you're going to see that the 3.5 and the $4 calls have a higher implied volatility, and even if you go out to November and back farther months, it does too. So this ratio spread or the repair strategy is even more attractive when you are getting the implied volatility of the calls that you're selling are juiced or a little bit fatter. And that happens a lot of times in these, biotechs or these high-flying stocks that the out-of-money calls are pumped up or much higher implied volatility. If that's the case, this is when the repair strategy works even better or is even more attractive.
Yeah, I didn't even really explore the farther out chains in my example, but if you look even farther out, 1 month beyond October, look at November, you can leg into that 3-4 for not much more, but 12 cents, maybe 13, 14, depending on how you leg into that spread. So you're not paying a lot more, and you get a whole extra month for that ratio repair to work in your favor. So depending on how you trade these things, you can really take advantage of some interesting things. I know we haven't delved fully into volatility skew yet on this show. Don't worry, that's coming in a little bit. And this kind of gets into some of that volatility skew stuff that John's just talking about here, about the upside call and how they're bid up from a volatility perspective. But you can just notice doing your own quick math that there is a little bit more juice in some of these calls than there would be in some other names. People obviously preparing for perhaps a retracement to the upside, which is a favorable thing if you want to leg into some vertical call spreads or vertical ratios.
Can I be heretical here? And maybe
please do. That's why I brought you on. You're my devil's advocate, Randall.
All right, here's heresy for you. When my clients buy a stock of $5 or less, I tell them, don't think of it as a stock anymore. Think of it as the zero call. Think of it, you have bought a call with a strike price of 0. I'm not a real big fan of doing a stock repair strategy on very, very cheap stocks, especially when you're talking about 10 and 20 cent spreads, because your commissions are going to eat it up. If you buy a $5 stock, I say, hey, you're rolling the dice on the zero call. Be prepared to lose $5. I believe in the stock repair strategy for stocks at least above 10 and preferably above 20.
Well, that's certainly, I agree with you in that sense, and that's why I mentioned at the top of this that this is a cheaper name than I probably would be doing this on. But still, it's a good real-world example where I know a lot of people are trading right now, so it's worth, just for the math's sake, show people how kind of what we're talking about here. But you're right, there is a very much a school of thought that stocks under $10, certainly under $5, are essentially options in and of themselves, and just buying the underlying is essentially trading an option. So that is certainly, if you are one of those people, you probably wouldn't be trading Dendrion anyway, or at the very least, maybe you are going to take the double down approach here if you like it. But this is certainly an example. I think it's worth looking. Everyone should go out, look at the options chain here, see those numbers I was talking about, see those strikes I was talking about, to get a feel for exactly how the pricing of these strategies works, how they perform at different stock levels. And once you do that, I think that'll give you a better understanding of exactly what we're talking about here, and how this version, the 1-by-2 ratio call spread version of a stock repair strategy, could be useful for you in some of your other positions and some of your other portfolios. Randall, anything else you'd like to add here on the old stock repair strategy?
Well, I would only say this. Some of the best trades I ever did in my life were taking a small loss. I would say if you've held on to a stock and it's gone down 20%, you've really waited too long. It's best to just bite the bullet sometimes. Take the hit. And once again, I'll repeat myself. If you believe in the stock, don't panic out. Sometimes a puking market will take all stocks lower. A rising tide lifts all boats. A receding tide tends to sink all boats. If you believe in the stock, it has a good yield, don't sell it. If you don't believe in the stock, or it was a trade, then never let it get to a 20% loss.
The one thing I wanted to mention also, I just want to reiterate why this strategy is so attractive, especially for our retail customers, and this is our customers that we're targeting on this podcast, is that it requires little or no margin. It costs 0 to put up. I mean, if you're gonna double down, remember you have to put down 50% to buy more stock, and you can put these repair strategies on, for very little money, a small debit or for even. So that's why it's so attractive to our customers. And later in the show, maybe we'll get into I know Randall loves this topic about synthetics, but there are other alternatives besides even doing the 1-by-2 that we can look at a little bit later also.
Yeah, if you take nothing else away from this segment, take this away from it. Don't double down on your stock by buying more stock. That really is just throwing good money after bad. In pretty much all scenarios that I could think of, doing what we're talking about here, doing a very limited outlay or perhaps even a net even outlay ratio call spread is going to be always preferable to spending all that money to buy more stock. There's just really no reason why you shouldn't be doing what we're talking about versus buying stock. So if you are that kind of person, you like to double down, you like to dollar cost average, you like to lower your cost basis by spending a lot more to buy more stock, think about what we're talking about here and use this instead, because this is definitely a preferable strategy, and it could definitely put your capital to much more efficient use in your account. And that's really what we're trying to get to here. Simple strategies that you can implement with your stock positions and usually just become a better trader by doing it and become a much more efficient and effective trader. And that's really our goal here on Options Bootcamp. So there you have it. Another review, a little bit deeper dive into the stock repair strategy. If you want to learn more about this strategy, check out episode 20 where we touched on it again there. And also the most recent episode of the Advisor's Option, where we touched on it there a little bit as well, from a different point of view for the CFAs, the CFPs, the asset managers, and how they may want to use it on behalf of their clients. But check that out, because some of our hosts on that show also express some other interesting ways that you can implement a stock repair, including selling calls on the way down and some other interesting strategies. Like I said, the stock repair, that's a very broad umbrella that a lot of strategies fit under, but once you start learning more about it and how it works, it can be a much more effective tool than just buying a lot more stock. All right, and that's going to do it for our basic training segment. Now we're going to keep on rolling right on into essentially my favorite part of the show, because it's your part of the show. It's the mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, and welcome to the mail call. This is, of course, a portion of the show where you guys get your chance to sound off and chime in and make your questions known to us here on the old program. Of course, comments, all that other great stuff. You guys have had no shortage of all of the above of late. Keep them coming. Surf on over to theoptionsinsider.com. You can post your comments and questions on the show notes for this program. Of course, you can find us on Twitter, twitter.com/options, Facebook, just facebook.com/theoptionsinsider, or the old-fashioned way, questions@theoptionsinsider.com. Just be sure to put in the subject line, question for Options Bootcamp, so we know which show to route your question or comment to. And we're going to kick things off today with a question from Mr. Nick Randall. I think this one has you written all over it. I think this couldn't be a more textbook question for you to discuss, so I'll let you have first dibs on it. And Mr. Nick writes, can you explain the difference between a front spread and a back spread? Thanks for the program. It has a regular spot on my podcast playlist. Well, Nick, we're glad you like the program. We're glad we can make a regular appearance on your podcast playlists. So we hope you keep doing that down the road. And it's a great question, the front spread and back spread, because it gets into one of the main problems a lot of newcomers have to the options market, which is just this terminology. It can be impenetrable to a lot of people. In particular, things like front spread and back spread that a lot of pros used to use, but a lot of retail never really encountered. And they start hearing some people talking about them, they get a little bit confused. So it's a good, I think, thought exercise, if nothing else, to walk our listeners through what each of these are. So, Mr. Randall, the floor is yours, sir.
Okay, a front spread means that the volatility, time decay is on your side. A front spread, the stock repair strategy is a good example of a front spread. Buy one, sell two. Time decay is on your side. You want your short option to decay faster than your long option. That would be a front spread. A back spread would be the exact reverse. Let's say you anticipate a really big move in the stock. So you would buy two calls and sell one call against it. This makes time your enemy. You really want that big move. A back spread is something you do if you anticipate a big move. A front spread is something you do if you anticipate sideways or a slow move.
Yeah, I think a good way to think of it is the front spread is exactly what we were just talking about in the basic training segment. It is that basic ratio spread that a lot of you are familiar with. Buying one, selling two, using the two you're selling to finance the buying of the one. We just talked about that in our vertical call ratio spread for the stock repair strategy. That is a use case for a typical front spread, and the back spread is turning that on its head, being net long units, being prepared for that big move to the upside or the downside by having more long than you are indeed net long, net short. John, anything you want to add here on the front spread and the back spread?
The only thing I wanted to add is that, if you're going to do a front spread, the front ratio spread, just remember one thing, that there is unlimited risk. And as traders, Randall and Mark can speak to this also. We would always net out a position. What does that mean? Well, if you do this front spread, you buy one, sell two. So basically, you're net short a call. So just be careful that there's going to be unlimited risk there. There's, of course, going to be higher margin requirements. So just as long as the customer is aware of that there's going to be a pretty high requirement for this trade.
And, I've been reticent to really dive deep into the front spreads, a.k.a. the ratio spreads, on this program, because I know a lot of beginning options traders, and they start learning about them, they say, wow, that's a pretty impressive and useful strategy. And if I can buy one and sell two, that covers a lot of my money. Now, what if I buy one and sell three? Well, now I'm collecting a credit, and that becomes a very slippery slope for a lot of new options traders, which is why we haven't really jumped into in depth on the ratios. And I'll talk about them like we did today in a very specific use case where 1x2 has a very, very specific use, and it is indeed covered by the call and the underlying position. So you're not talking being net short on that ratio. But I've been reticent to dive much beyond that on this program on the ratios. Maybe we'll do a show down the road where we talk about ratios and some of the use cases for them. But I'm scared to give people the green light to start writing ratios, because then I know how this road goes. They start doing 1x5 and then 1x7, and then pretty soon that you're getting a call from a guy like John saying, hey, your margin's out of control, your count's out of control, and you're blowing up because the stock moved 20 basis points or what have you, and you blew up. So that's why I haven't been a huge proponent of discussing ratios. But a great question, Nick. Randall, maybe this is an interesting one for you too. We had someone else write into one of our other shows on the program recently, a similar type question, but he wanted to know the etymology, the origins of the terminology front spread and back spread. And we got into a very lively debate on that program about where that terminology actually came from. What's your take on where the terms front spread and back spread originated?
Well, the front spread basically just refers to it being in the front month, being a standard plain vanilla spread. And the back spread is just basically, the etymology is the back spread is the antonym of the front spread. It's the other side. You can have a big debate about doing 1x2s or 2x1s, but I will say this. I want to do either of them for a net credit. And I want to underline something that Mark said, and John also said. I do not believe in options positions that have unlimited loss potential. If you really, really, really want to do a front spread, i.e. a 1x2, and not in the form of a stock repair strategy, but purely as the front spread, then why don't you butterfly it out? I do not believe in undefined risk. It can work 10 times in a row, and the 11th time can blow you out. I can't tell you how many times I've seen that. And anyone here this is Bootcamp, right? So these are rookies out there. Anything that has unlimited risk, I would avoid like the plague.
Can I mention one more thing, Mark, also about the ratios? And this ties back into what we were talking about before with the strategy, the repair strategy. I get customers that call and say, I can do the 1x2, that's fine, and now my break even is now 95, but how about if I do a 1x3, 1x4? And then they start doing the numbers because we've taught them how to do the numbers and the break even. And they're like, wow, look at my break even now is 91.5 or 92 or whatever the case might be. So that's what Mark was saying. It's a very, very, prescient point that it's a slippery slope. Don't get sucked into, 1x2s are good, but how about 1x4s? There's an allure to sell premium and sell these options, but just be very, very careful about having the ratios, get too out of hand.
Long-term capital management, a fund run by 5 Nobel Prize winners, sold anything that was more than 2 standard deviations away from the money, and they blew out like a Roman candle.
Yes, that's the classic example of mean reversion, not exactly reverting in the time frame that they needed, shall we say, to be charitable. But of course, if you'd like to learn more about what Randall just mentioned and the butterflies, if that term intrigues you or confuses you, I encourage you to head on over to our episode back from January of this year, episode 14. We talked about advanced spreads, a.k.a. the spreads with wings, the butterflies, the ironflies, the iron condors, and that'll explain to you what Randall's talking about there, how the ratio spread can then turn into a butterfly if you just add that extra protective component so the worst doesn't come to pass. Of course, doing that goes contrary to what a lot of ratio traders are looking for, which is maximum credit, maximum income. A lot of them are hesitant to really spend that extra money on the protection way out of the money, which is a whole other conversation in and of itself. But I think we'll move on now to our next question here, a good one from Mr. Avalon 360. He writes, I've heard a lot of talk about covered calls. They are an interesting income trade, but they seem to be leaving money on the table, namely the puts. Why doesn't anyone talk about covered straddles? After all, if you're comfortable selling the vol or premium on one strike, you should be comfortable selling both and collecting twice the income. Great question here, Mr. Avalon 360, and there's a lot of interesting reasons why that is not exactly the case. Why we don't see a lot of people talking about covered straddles for a variety of reasons. First off, if you missed our episode here, I'm throwing back to a lot of older episodes here on the show today, but it's very important in this case. Go back, listen to episode 18, The Joys of Synthetics. That's where we knock out all the different discussions about covered call is actually, by using synthetics, you can see from a risk profile and a risk perspective, is actually equivalent to a naked short puts. And once you realize that you're doing that, when you're selling the covered call, you are selling the put. So by selling the put in addition, that becomes an interesting trade and also perhaps a little bit risky for a lot of people because you are just doing the same trade but more of it. And that's something a lot of people just don't choose to do, or their margin may not be favorable for them, and it doesn't really work out that well. Mr. Randall, what's your take here on Mr. Avalon 360's question and the concept of the covered straddle in general?
All right. First of all, if you sell a straddle naked, you're really asking for trouble. And I'm going to flip it over to John in just a minute because he would know more about margins and such. Selling a straddle naked is just a huge risk, which requires you to put up a lot of money. I really don't believe in it. I will say this, though. A way to sell a straddle in a covered way, and this is very popular with asset managers in the Netherlands, is to sell a straddle and buy half stock under it. For instance, you sell the at-the-money straddle 10 times and buy 500 shares. This means you're willing to buy another 500 shares if the stock goes lower, and you're willing to sell your stock if the stock goes higher, and if we stay even within the boundaries of the straddle, you make money. This would be an example of a covered straddle. Once again, they'll be selling the at-the-money straddle and buying half the amount of stock under it.
Again, Randall is stealing what I was going to mention, that if you're worried about that, you just do exactly what Randall said. You just simply purchase half the amount, enter into the straddle, and then if things go awry, then the stock gets put to you, and now you've owned what you wanted to own in the beginning. So, the straddle margin is not actually that much crazier than a regular being short or call or put. It's just that you have to be, up or down 20% minus add the money amount, and then plus a premium of the other side of the straddle. So, so it's a little bit more, but it's not that significantly more. And the one thing also I want to mention about all these strategies, be very careful when you're doing these strategies in these high-flying stocks. They're great for us because people trade them a lot, but in like the Teslas and, Dendron before, it crashed, and, LinkedIn, all these stocks that move so violently, just be very careful because there's also a higher requirement. So you're not really putting a lot of your money to efficient use when the requirement, instead of being 20%, is 40%, 75%. So just be very careful with that and be very aware of that. And customers can always call in, or they can send me an email, or I can give them the list of the requirements that the underlyings that carry this higher requirement.
Yeah, it's a good question, Mr. Avalon 360, and a couple issues that Randall and John just touched on them. I will just add my 2 cents as well. Is that, first off, what you mentioned isn't a covered straddle. What Randall and John mentioned really is a covered straddle, because let's say you have 1,000 shares and you write 10 calls against it on the typical covered call scenario. Then you turn around and write 10 at-the-money puts on that same strike. Well, those aren't covered. those are now essentially you've agreed to add to your stock position if the underlying drops. So now essentially you have a position where the covered call is covered to the upside, of course, and you'll be called away on that sense, but if stock drops, now you also have that additional put you're going to be put, that put is going to be assigned, is going to be put to you, and you're going to have double the amount of stock. So that's a scenario that you're okay with. This may be a strategy for you, and this is something we've seen people do. Obviously, you can do the way Randall and John outlined, that they have a stock position. They buy half as many as they want, and then they use the straddle to perhaps add to the other half. That's certainly an attractive way to go. Some other people may like to use the put to work some additional stock into their portfolio. So if you're looking at a period where you have some stock and you want to add some more and you're also looking to generate some income, this idea could be useful for you, but just be sure you understand exactly what you're doing. Understand the synthetics and understand that if this underlying drops, you're getting more of it. So as long as you're comfortable with that, this could be a potentially attractive scenario. I will add one other thing. Our friends over there at the Options Industry Council, they do a lot of great studies on this exact type of thing. And they do studies on the collar. I've discussed them on this show in the past, particularly in our collar episode, and how effective that strategy can be in a variety of underlying scenarios going back decades or more. And other strategies, covered calls, they've studied a lot of things and how these different strategies can be used and how interesting they could be. And one thing they kept coming back to was kind of your exact question. They kept coming back and saying, well, this covered call strategy is interesting for a lot of advisors and asset managers and even high-end retail traders. What if we added this extra kicker, this extra component? What if we started doing essentially a quote-unquote uncovered, let's call it, straddle, right, where they have stock and they write the call and they do exactly what you said, they write the put as well. And they started going down that road. They started studying it. And it certainly was generating more returns. But just talking to the community that they wanted to show this research to, the asset managers, the financial advisors, the high-end institutional traders, and other guys, the notion of getting more of that stock, it really was just unpalatable to a lot of them. They couldn't really wrap their heads around the additional risks. They didn't understand the position that well. They understood covered call. They understood they bought the stock, it rallied, the stock was gone. They understood that. Even if they were a relative novice from an options perspective, they can wrap their heads around that. But adding the put component, getting into the synthetics, getting into adding more underlying if the underlying dropped, a lot of that was just pretty much too much. And the additional complications and additional risk didn't really offset, in their opinion, the additional income they were generating from the strategy. So they ended up killing that study because it just didn't seem like it was resonating with the intended audience. So there have been people who've explored this in the past, Mr. Avalon, and it hasn't really resonated. But perhaps if this works for you, I would encourage you to do it perhaps the way Randall laid it out first, is take half the stock position and then try it out and make sure this is A, what you think it is, it performs the way it is, and you have a good understanding of the synthetics. And then maybe going forward, you have a stock position you have already, and you're already writing some calls on it and generating some income, and you want to add more to that stock position but don't want to sell it at the same time, then this could be an approach where perhaps you leg into this straddle so that you could get some better overall income generation and perhaps get some better prices for buying that stock. So it's an interesting question, an interesting use case. I think for a lot of our listeners, it may be a little bit scary. But if you understand all of the risks entailed and involved in this strategy, it could be perhaps an interesting one for you to employ. Mr. Critchley, anything else you'd like to add here on the whole covered call? On the whole covered straddle concept.
The one thing I wanted to just touch on very quickly, and I want to repound it home today, is the idea. And maybe this should have been in one of our shows about myths or mistakes, doubling down. That's why this strategy repair is such a great strategy, folks. Doubling down. For every time you double down and you get lucky and the stock rebounds, you're like, wow, look at me. I've done so well. You're going to get so many cases where you have Dendrion, or you have Netflix, or you have Apple at 700, now 485. It just doesn't over time work. If you have a problem and you have a long, horizon, you want to own the stock and try the strategy. Try it. There's no risk. Remember, if you put it on for there's no outlay, and if you double down, guess what? You have to put up the cash. So just go back and just never double down. It's just not a winning strategy.
Randall, anything else you'd like to add, either on the covered call or perhaps just in general before we wrap up the old mail call segment here?
Yes, I would like to add two things. One, I would like to underline about 10 billion times what John just said. As I said earlier on, I hate the idea of doubling down. don't reinforce failure. Any military person would tell you that. And the other thing I want to say is selling the at-the-money straddles, fine. But why not buy the wings? Why not turn it into an iron condor? But that's probably something else for another show.
No, we've hit on iron condors on this show here, so people have, if they've been listening for a while at least, they have an understanding of what you're talking about. If not, like I said, they should go back, listen to our archives, our advanced spreads episode from January, I believe I mentioned, and that will walk you through that. And of course, you're right. That is why the iron condor has become such an attractive strategy, why there's so many newsletters and guru services out there hawking the iron condor, because it allows you to capture most of the benefit of the selling the straddle without all of the risk. It is a risk mitigated strategy for the most part, particularly if you know how to manage it. Managing these positions is a whole other conversation. That's probably several shows in and of itself. But still, interesting questions all around. I want to thank everybody for writing in again. If you'd like to join our friends here on the program, find us on theoptionsinsider.com. Leave a comment, leave a question on the show notes there. We'll be sure to route it to the appropriate show. Or find us on Twitter, twitter.com/options, Facebook, facebook.com/theoptionsinsider, or the old-fashioned way, questions at theoptionsinsider.com. Just be sure to put the show you'd like your question addressed to in the subject line so we know how to route your question. A lot of great ways for you guys to get in touch with us, including pretty soon our mobile app should be launching in the next couple of weeks, and that'll make it even easier for you guys to A, find these shows and listen to them, and B, give us your feedback. Let us know what you're thinking about these different shows. So we're looking forward to that as well. Stay tuned for that. And unfortunately, that's all the time we have for today's episode of Options Bootcamp. But before we go, let me check in with my cohorts, my partners in crime, the yins to my yang here on the old panel. Starting off with you, Mr. Randall. What can our listeners look forward to from the list report in the coming weeks?
Basic options education that simplifies and demystifies.
There you have it, listeners. Simple and no mystery over there on the list report. And Mr. John, what is cooking in the land of SogoTrade.com?
Yeah, we are going to launch this Thursday as we record, so the next few days, our margin optimizer. So I've been working on it, and I actually tested, just to make sure, I tested the the covered straddle, and I tested the ratio. Everything looks great with that. I also want to go off topic here for a slight second and say there's been an issue about the penny pilot program being made, permanent. I guess it was a test program, and there's been some resistance from the market makers. And even as a former market maker, I just want to say for the retail customer, the penny pilot I think does work. That's my opinion only. So I just wanted to mention that. And you can always find me at Sogo Trade Option with my Twitter account, our Twitter account, and of course on Facebook.
And listeners, if you haven't done it by now, you've been listening to this show for a while, by all means, surf on over to SogoTrade.com and open up a free account. Kick the tires and light the fires, as they say, and see if that works out for you. They have a lot of great tools. The prices are oh so low, so if that's the place you want to execute your trades, I encourage you. If you haven't done so already, surf on over there, give them a try. I think you're going to like what you're going to find. There's a reason they've been on this show for so long and helping to support it, because they know you guys out there appreciate a good platform and a good value. So surf on over to SogoTrade.com and test it out for yourselves. And John's a good point about the penny pilot as well. I hadn't intended to broach that, but now that you did, we have a couple minutes. I can really dive into it for 2 seconds. But you're right. It is an interesting point. Our friends over at NYSE seem to be spearheading that, because they're the ones who kind of really got the penny ball rolling with a lot of this maker-taker stuff and some of the early initiatives over there. They've been big fans, big proponents of penny pricing for a long time. And you're right. I think it has benefited retail tremendously. Of course, it has caused other issues on the other end. I think it has tightened the spreads to the point where there's not as much liquidity on them. And if you're looking to do, particularly some of our listeners who are becoming a little bit more advanced now and looking to do even simple spreads, 10-lot spreads, once you get adding multiple legs to your options trades, the penny pilot can be a little bit more difficult because the liquidity simply isn't there. So I would like to see, if they are going to make it permanent, they add some mechanisms for removing names that perhaps aren't well suited to penny liquidity and making some adjustments instead of just making everything pennies willy-nilly and then letting the chips fall where they may. 'Cause that's solving a lot of problems, and it's causing some others that we haven't really seen addressed yet. So, but an interesting topic, maybe, who knows, maybe we'll discuss pennies on an upcoming show one of these days and how that's impacted the retail trader. A lot of grist for the mill there as well. But I said it before, I really mean it this time. That is all the time we have on this program. On behalf of Randall and John, and don't forget Mr. Dan, who's off on assignment, will be back soon. Check out markettaker.com to see all the stuff they have cooking over there. And we'll see you next time right here on Options Bootcamp.
Options Bootcamp is brought to you by Sogo Trade, an extraordinary value in online trading. Why pay more for the same trade when Sogo Trade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Options Bootcamp is produced by the Options Insider, Inc. All rights reserved.
The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.